morning, Brian. How are you?
I'm great, Ryan. How are you doing?
I'm excited. I'm excited to chat with you. I sent over my questions and I'm like, man, if only I could have 5 more hours. No. Let's quickly cover these topics in great detail. No, I got to start right where you left us off. Right as we were wrapping up, you're like, and ask me about China next time. And I think that went into the ether. The Wall Street Journal picked it up. The Economist picked it up. And now everybody's talking about it. So you already anticipated this based on your guys' data. And you want to just use that as a liftoff point?
Yeah, there's the most obvious thing that people have picked up on is the declining demographics. The population of China is shrinking, and that is detrimental to economic growth, at least organic economic growth. That means you have to conquer more lands if you're going to have any sort of growth, which obviously with China, you think of Taiwan, you think of the Spratly Islands. None of that is a good scenario. Mm-hmm. And what other people have not necessarily read about yet is just how highly leveraged that Chinese economy is. So like declining population, highly leveraged, and this has been reported on, but I'm not sure how many people picked up on it. While we're contending with inflation, they're contending with deflation. Their CPI is in negative territory. So that's a triple header of problems going on within China. At least the deflation helps in terms of making their debt more affordable, but it's, for anybody from an investor outward, it looks upon that and you go, oh, there's rigor mortis setting in on this corpse.
Yeah. And Brian, how does that, then you got what was the stat too of 22% of the young adults don't have any jobs? Or I don't know if it was young males or if it was young, both females and males, but you have people it's a lot of stuff happening at the same time in that tinderbox. And then the Evergrande I was looking at, and what was it? Is it Garden something or another? I'm watching those numbers and I'm like, oh boy, good luck turning that ship around. How do you keep the cash coming? And I think the other stat was 150,000 people that don't have homes that already paid for them or something ridiculous like that.
It is incredible. So you're going to find the communist government tightens control more and more to make sure that civil unrest doesn't rear its ugly head. And it's just going to get nastier and nastier in there. And we can look there and see the declining opportunities there, or you could look at two other factors. One, India's population is now greater than China's population. That's a huge tectonic shift. Mm-hmm. And India intends to take over China's pole position as a manufacturing entity on this planet. And they can do it with some improvements to their infrastructure, a lot of improvements to their infrastructure, and being more open to Western money. But they could pull it off. And that just means a huge shift in cash, foreign direct investment, trade, airline flows, ship flows. This is huge. Mm-hmm. And we're going to see it unfold over the next 10 to 15 years. It's pretty cool.
I love how it's pretty cool because it's interesting watching it all unfold. And that's what I'm becoming more and more. I don't know if it's better watching it unfold in an objective perspective. Hey, this is kind of how it's going down. And your framework has helped out a lot. I just have this picture blasted into my brain of all of the BRICS people holding their hands up going, yay. And I'm like, and then we're not there. And so I'm thinking of how does that association of BRICS and opening up the BRICS cohort to different countries impact kind of the monetary policy underneath this shift? Is there anything we should be thinking about?
Ask yourself, why are the BRICS opening up and welcoming others in? Why are they doing that?
They don't want to be working with us, would be my thought.
Maybe, or it's because a couple of the major BRICS, Brazil and China, are not worth talking about. And they have never, China's losing, as we just talked, and Brazil's never developed its potential. Yep. So they need to broaden their economic basket, if you will, in order to be worthwhile talking about it. And those same BRICS have been selling a lot of U.S. debt, right? And they're selling the U.S. debt partly because they want people to have the perception of what you just said, that they don't want to be part of the dollar anymore. Mm-hmm. But there's also an interesting line of thought, particularly in China's case and Brazil's case. They need the money.
It always comes down to the money and the cash flow. It's and I think about in the Belt and Road was so important as part of China's investment thesis and how much investment they made. And from what I've gathered anecdotally, like it's not paying off the way it should. So there's all this debt with all these people, and the big players are not chugging along like they should be.
Right. And one of the bricks is Russia, and their cash flow is strictly from oil, and thanks to China, but it's very tenuous. So they need to de-dollarize and have some more cash reserves. It's not a mainstream movement, though. That's what people need to keep their perspective on. We look at central bank reserves across the globe to see if there are any significant shifts toward gold, away from the dollar, toward the yuan. And last time I looked, and it was about 2 months ago, and I know things have changed since, but when you're talking about the size of dollars we're talking about, 2 months isn't going to change much. 3% of central bank reserves were held in the Chinese currency. 3% were in Canada's currency. Wow. That's how important the Chinese are.
Math, numbers don't lie, do they?
Nope.
Oh, it's interesting. Hey, what was there any gold movement? I found myself down a rabbit hole of looking at the central bank's balance sheets half a year ago or something like that. Is there any kind of significant noteworthy news about the gold in any of these banks? I don't remember what the details were.
No, not that I recall. And I've been following gold because we have clients who are investors who ask about gold. And gold's a really interesting investment to make at any given time. And I can understand why central banks hold it as a relative store of value. But in a day and age where people are still investing in cryptocurrencies, it just sort of seems like, what?
By the way, I've got this 16 pixel NFT I'll sell you for $80 million, Brian. I heard it's going to be the next thing. Yeah. Define intrinsic value on that one, right?
Yeah. Right.
Oh, too funny. All right. So I have been consuming, and I absolutely love the trends report and the material that you guys are pumping out. And I was, when I was prepping for the questions of kind of where these different industries are in the business cycle, I just find it so fascinating where people's minds are at and where the data's at and the kind of the lag effect behind it. And it's kind of the first one is the housing. So as I was looking at, the housing kind of getting into hitting the bottom, you want to kind of explain again, we got the 4 different cycles and how the lag effect happens and why housing actually might have already hit the bottom. And I think back to your point, the mainstream news is not talking about that in the way that you are talking about that.
Right. There are some interesting green shoots in housing, to answer that part of the question first. So it does seem it's still in front of, we think of the economy as a train, and there's 4 different phases of the cycle because there's 2 hills that we look for things to industries to be going through. And at this time, housing is one of the early turners that it seems to have gone through the valley of death, and it's on its way up. You look at building permits, they're coming back up. Existing home sales are creeping back up, but part of the creeping part is because there's just not much inventory out there. But even with that restriction of inventory, we're seeing some pickup in that existing home activity. And that tends to be an okay leading indicator. The correlation to the overall economy when it comes to new homes is not that strong, but existing home sales leads the industrial production, GDP, which are the anchors of the economy, the coincident indicators, on a rate of change basis by 15 months. So this is a big deal, right? And sometimes it can be as long as 27 months. It depends on what the slope of that rise looks like. And so far, it's taking off slowly. But it is an early sign that, yes, there's light at the end of the tunnel, and it's not another train coming at us. It's the sunrise that we all been anticipating.
That's exactly what happens to my brain when I think about this stuff.
On the other end of the train, though, you have non-residential construction, which is going through the apex of the cycle and is about to go careening downward. And anybody who's been following the commercial real estate market and what that means for the banks can understand why that whole industry is going to find itself in a credit crunch that is just going to bring that to a grinding halt, relatively speaking. But that's at the caboose. In between is retail sales and GDP and industrial activity and manufacturing in general. New orders will lead production, getting back into that train concept. And I just looked at total manufacturing new orders. And over the last 3 months, it's down 0.6% from the same 3-month period 1 year ago. So it's like you're just dipping your toe into the swamp, but we're feeling the swamp already there.
The mud is there.
Yeah. And it's because consumer inventories are an issue. People are concerned about the consumer being able to spend. So, and again, the banks aren't lending money. So all of this sort of makes sense that we're going into this icky period. And you and I have talked about this before, largely thanks to these ridiculously high interest rates. I mean, I agree that they had to go up, but they didn't have to go up like a Saturn V rocket or a SpaceX rocket or whatever I'm supposed to be saying now.
It's a balloon, Brian. It's a balloon. No,
shoot it down, Dan.
That's great. Well, and it kind of this ties into, before I go into your overall kind of next 36-month perspective of kind of where this is going, I want to go back to that in a sec. But what I find fascinating about the train concept is housing is seeing the light, which the amount of conversations I have, Brian, of like, it's going to crash, because everybody just thinks about what happened in the last part of their life. Yes. And I'm like, no. It's going like, this is it. It's like where housing is unaffordable for most people is another pain that's different, especially if it's coming through. But what I think is so interesting about the Make Your Move book and what you guys do with the data is like all of these companies, or not companies, all these industries that are on the apex of the C growth cycle. Can you explain why it's so dangerous in the C cycle of what these industries and the heads of these companies potentially could be doing if they're not paying attention to your data?
Oh my gosh, yeah. At the top of C, so very late B, early C, you're riding high. The year-over-year growth numbers are terrific. People have a history bias, whether it's the last minute, the last 2 years, or the last business cycle. That's what they tend to develop in their heads as a paradigm. So I've been successful. I've led this company for the last 2-3 years. Everything's been turning to gold. Let's just keep doing it. And let's build, and everybody who's been in business long enough knows this, let's build another factory or another distribution center at the top because, damn it, whatever we touch is going to turn to gold. We need it. We know we need it. Just look at the last 2 years. And how many of us can count off the number of factories that have been built or facilities that have been built at the very top of the business cycle? Mm-hmm. You know when I know when a business is really in trouble? When they're riding that crest of the cycle, right? Mm-hmm. Late B, early C. And they say, this is a great time to remodel the office. And I'm thinking,
beanbags and ping pong tables are coming back, Brian.
Yeah, let's not remodel the office so much as do some missionary work into new markets or something, you know? I mean, really?
Oh, it's in I've watched it too, Brian, where it's like people are just making these bets and you're like, and even people like myself or you're the people that are following you guys, it's like you still kind of second guess yourself. You're like, I'm looking at the data. Why are these people doing this? And it's kind of hard to fathom that someone is making that kind of bet with that little of information.
Yeah. And a lot of them are drawing it from the worst possible sources, which isn't a podcast like this. It's from reading the headlines on mainstream media. Mm-hmm. And the way the algorithms are, you get self-reinforced information all the time, right? Mm-hmm. So, well, of course I'm right.
Let's go buy it. There we go. I read the headline. Let's build a factory. It's confirmation bias is real and alive and well. So that with the context of housing starting to come up, and then you got the commercial real estate and a lot of the other industries in between and the B and C. Maybe this is a good spot for the IT indicator of, you know, you got the 2023 slowdown, 2024 recession. And I like how you just say it. It's a recession, soft landing, this and that. Is it a quasi recession? You guys are saying like, hey, there's going to be a contraction, but then there's 2025 growth. when I think about that, and let me know if I'm thinking about this the right way, where you got the interest rates that were jacked up that fast, and it takes a long time for that stuff to set in. And then when I think about, so interest rates are starting to actually, the golf ball is going through the garden hose. You got student debt that's starting to kick in next month of what, 40 million people between $200 and $500 a month or something like that. And then
it's more like 200 to 300, but that's okay.
Okay. Yeah. I'm just trying to thinking about all these things that will lead up to the next 18 months. So how do you kind of put it, like, what's the thought behind the container of the 2024, then 2025?
Well, a lot of what you said pertains to 2024. If people are going to start repaying their debt, but not everybody's going to be doing that because the government's trying to find another angle, right? And it's interesting. And one of the reasons why we're seeing the green shoots in housing, and this is important to remember, is that interest rates normalize. And what I mean by that is 7%, 7.5% becomes, okay, well, I better get that before it goes even higher. I'm not going to get 3.5%. I'm not going to get 4%. I'm not going to get 5%. So I need to make my move now. So the shock of the interest rate rise is over with, and you're seeing it in housing. And that's a terribly good sign as far as I'm concerned about 2025 getting back on track. My major concern about 2025, Ryan, is Jackson Hole seemed to be all about warning us that they intend to hold interest rates high. They may stop raising them after one more hike here in 23, but they don't really have any serious intent about lowering them, at least for the first half of 24. And that scares the daylights out of me because we need to get the inverse yield curve normalized by lowering these short-term interest rates. And when I look at the mountain of debt in that commercial real estate market and what it's going to do to this regional and small banks who own 2/3 of this $3.6 trillion worth of debt. And so much of it needs to be refinanced in 24, 25, and 26. If the Fed doesn't start coming around and being accommodated with interest rates, they're going to create something that could take 25 and take it off the table in terms of seeing a recovery.
Okay. Well, that's kind of what I was like. I'd full disclosure for the listeners, I had sent Brian, I'd screenshotted a couple Wall Street Journal snapshots. I sent it to you and I said, I know old habits die hard because I'm looking at the headlines, but I like pictures, and I saw the pictures of how much has to be refinanced between corporate debt and real estate debt. And I'm going, I would not want to be the person looking at the math behind like refinancing and that timeline.
Yeah, one of the things the Fed can do, though, is change the rules, Ryan, and they can say, all right, you don't have to mark the value of that mortgage down on your books. You can carry it at origination value. So the banks don't look as bad and their loan ratios don't look as bad. And you just try and wink and nod and hope it all goes away when interest rates do come down and the market recovers. So they have that sleight of hand capability. We've seen them do it before. They haven't said they're going to do it, but they can't be so silly as to think they can create this sort of a problem in the economy and not do something about it.
So how does this situation then impact? How is it impacted by the downgrading of the middle market banks that we saw?
Well, it makes it worse. I mean, with the downgrading, are you talking about the rating agencies?
Yeah. So now, maybe kind of because I think people saw that, but I don't think a lot of people know really intrinsically what that means to any of these issues that we're talking about. So like, what happens when they get downgraded? Like, how does that impact lending and their clients and some of the situations?
One way that can impact lending is you have to be a lot more cautious because one avenue to raising fresh capital, just the window closed a little bit when you got rated at a lower level. You're less interesting to invest in, and you're less interesting to lend money to unless I'm going to get compensated for that additional risk. Unless you're even with the United States, we got our notch taken down a little bit, and we haven't seen long-term interest rates yet on the 10-year bond yield come back down. We're still flirting at 4.25%, 4.3% because of that move. Well, and probably because of some of what the Chinese have been doing.
Yep. And so when I think about the inverted yield curve, you had mentioned that. So there's been some talks. I think we covered this on one of our last conversations, but maybe kind of a quick synopsis again of what the inverted yield curve is, because the mainstream media is like, hey, does this matter anymore? So they're kind of trying to like change how the actual fundamentals work, I think. So maybe any comments you have on that situation?
Sure. It matters 88% of the time, so you can't say that it always matters, but 88% of the time is a pretty strong number. It matters because it distorts behavior. If we didn't have the inverse yield curve, the banks would not have found their balance sheets so badly trashed. They weren't heavily into long bonds because that's normally the better way to go, but you invert the yield curve and all of a sudden you need short-term bonds, not long-term bonds. And we find the Chinese are selling, and this is why you have to be careful about what the Chinese are doing. They're selling off U.S. government securities, particularly the long bonds, right? But it's not like they're flipping off. I don't know how else to put it. The U.S. economy, because they're buying U.S. government agency bonds instead. They can buy a short-term agency bond that's paying 200-400 basis points more than the U.S. government 10-year bond. Mm-hmm. Well, why wouldn't they? Mm-hmm. Why wouldn't any sane person do that? Mm-hmm. Even some of our allies have done that. So it distorts behavior, and it distorts the normal flow of thinking within the economy, and that's what tends to get you into this mess.
And we're trying to get back to some normal, like Becky, you said, what was how did you word once the interest rates become normalized, it's like, hey, we need like this normalized economy that is a little bit more. I mean, we can project it out. We can assess the risk of the different bets that we're playing. And I think it's just been difficult as all the scenarios we're talking about make it difficult to see through the clouds of,
and we were addicted to those low interest rates for like 10, 15 years, right? I mean, we were addicts.
How does that impact so when I saw a graph about the cash flow from operations from Visa and MasterCard on Visualize a Capitalist. I don't know if you ever come across that. You probably have way better data and different graphs, but like I saw this and I was like, holy buckets, like how they've grown from the credit card debt, and consumer debt in general has been this topic of conversation. So how should I or the listeners be thinking about the kind of the two comments from two sides of the same coin of like, there's the resilient American consumer. I'm like, well, are they resilient or are they just racking up credit card debt and consumer debt? Like there's a truth probably in between there. And I'm just kind of.
There is. And you always have to keep in mind, and I too ain't like the visuals. But one thing that's great about people who like visual data is I can always make the chart say whatever I want it to say, but choosing the time period and the scale.
Yeah.
Right. So that's what I tend to like, the long-term perspective, and I also tend to like the data that go along with it. When I look at my approach to the data, they're in more debt, but they're way below their credit threshold, and the debt load doesn't seem to be crushing. I can come up with all sorts of scary statistics, but for instance, credit card delinquency is still running below where it was pre-COVID, that 10-year average. Mm-hmm. Automobile delinquencies are very low. Homeowner delinquencies are very low. Those are the numbers that matter.
Mm-hmm.
Not anything else.
Not the quantity, because it's got like, and I think it's so important what you said. I'm just want to highlight it for the listeners. Is it's all context, Brian, and that's what you guys do such a great point of like, here's the context over time, here's the data, so it actually has got relativity. Because without relativity, we're just making stuff up, and we can.
Yeah, without relativity, we're politicians.
I will refrain from taking that candy that was right in front of me.
Come on, I threw you a nice big chunk of bait there.
You did, and I will use some self-discipline. So, I have a question about how the 2030 and prosperity in the age of decline in your guys' model. How does the dramatic wealth inequality and like the quantity of Ray Dalio's got the long-term debt cycle, and I know that that's how he's been labeling it. But you guys, your book, I just need to be so clear, was seriously one of my favorite ones for applicability. Honestly, Brian, I was like, Ray Dalio he was just like, oh, there's more of these things, and I'm like, great, but what the hell are we supposed to do about this, and how does it matter today? And it's like, boom, there's your guys' book. It's so practical. It's honestly like so well written. But how does the inequality or long-term debt cycle, or should we even be thinking about it the way that he thinks about it? And how does that all play into your framework? And if we have to kind of tee up this next time too, we can.
Yeah, we'll tee it up for next time in greater depth. But the inequality, the income inequality, is going to continue to increase. The deck is stacked in that direction. It ebbs and flows, but that's been the trend since the 1980s, and we're not really going to easily get off that trend. It's in the 2030s that you find social structures, our laws change to address those income inequalities. And that's easier to do when us baby boomers are passing away. Because while we have the power and the money, we'll have neither when we're dead.
Death and taxes. I mean, right? Well, it's interesting. That's another reason that I just absolutely love your guys' book, Brian. It's so practical. And I've even been telling people, like, you don't have to be an economist to read it. I mean, it's such like, and what I love about it, Brian, and everything that you guys do is it's taken, for me, my personal experience on this is it's just taken the pressure off of needing to understand all the day-to-day crap, because it's not necessary. Like, what people are like, well, why do you have your business plan towards 2030? I'm like, because I know that there's a bunch of people that are going to be 10 years older than they are right now. and I just don't have to be a genius to actually build a plan around that. And they're like, oh, it doesn't need to know the PE ratio tomorrow of some stock.
Exactly.
Brian, this is always a pleasure. And thank you so much for coming to the show. And I will see you next time.
It is always with gratitude that I am on the show. So thank you. Take care.
I hope you enjoyed that conversation with Brian from ITR Economics. There's a lot of information there, and there's a lot of data. And I think one of the biggest questions people have is, what do we do about that? I would highly recommend going and checking out their book, Prosperity in the Age of Decline. It'll answer so many questions. And then sign up for their ITR Economics Live Trends Report, which there's a monthly subscription. You can go learn more about that below, where you can get more data on where things are at in the different business cycles and the ITR long-term view. A lot of material there that I highly recommend checking out. And why I'm very excited for the next segment, which is Doug from the National Center for the Middle Market, is they survey 1,000 C-level executives from CEOs, CFOs, from different middle market companies about their thoughts about where the country, the economy, and therefore their company is headed. And for some perspective, there's over 200,000 companies employing 48 million people in the middle market. It's the middle market that you're hearing me constantly talk about from the U.S. Census Bureau. So we're actually polling the people that are in the biggest segment about what they think is going to happen. And there's some fascinating comparisons compared to the public data, which is why we're doing this podcast. So revenue growth is in the double digits compared to the S&P 500. The employment growth in the middle market is actually still in double digits compared to the low single digits. And one of the questions that I think is so fascinating is the National Center asked the C-level executives, if you had an extra dollar, would you rather invest it or save it? And Doug's going to be talking about their responses and why. And then what is their economic confidence in the future and how they're planning on positioning their company and their strategies to navigate the rest of this year and next year. So I hope you enjoy this conversation with Doug, and then we're going to dive into what's actually happening in the merger and acquisition environment and deal volume, deal structures, valuations after the National Center conversation, because I think once we understand what's going on in the economy, what's going on in people's heads, then we can kind of start to see how that's translating into deal volume, deal structures, and valuations when we talk to Jeff from ButcherJoseph. Good morning, Doug. How are you?
I'm doing well, Ryan. How are you?
Super good, man. I'm very excited to dive into your guys' new report. It was halfway through the year, and it's super fascinating, Doug, as I've been having more of this cadence with ITR as we've been doing these quarterlies, thinking and looking at their historical trends and looking at their and their future data and how it reconciles with the polls that you're taking. So they've got the economic data and we're reconciling it with the people actually making all the decisions. It's super insightful because of how many correlations there are, which gives me more confidence in the data, which is exciting. So why don't you, we got the 5 main buckets, right? You want to how do you want to tackle them? And you got us, for the listeners in, we'll be giving commentary, but there's also, if you chose to go over to YouTube, we'll be able to show the actual slides that Doug's going to be putting up.
Let me pull up a tab here for everybody to kind of look at while I go through it. Yeah. So again, I'm glad to be back on your podcast, Ryan. Appreciate your interest in the middle market, and certainly it's within our center's mission to try to share as much information as we can about these companies, about how they're doing, about some of their challenges and some of their opportunities. So I would say, the main storyline that we get out of our mid-year 2023 middle market indicator, which, by the way, we collected all this data in the first 3 weeks of June.
Okay.
So, our process is to go out and survey 1,000 C-suite financial decision makers at these businesses. So we look at, all different size companies, every industry, every part of the country. All that data does get weighted back to the U.S. Census, so that's reflective of the makeup of the middle market. But, essentially, I don't want to sound like a broken record, but it's like performance, continues to chug along. I would say, ever since the recovery kind of coming out of the pandemic, we've seen 2+ years of really strong performance out of the middle market. And I can kind of walk through some of this data. What I'm sharing here is kind of our dashboard, we like to call it, in terms of the summary of the performance. So first place you start, just looking at top line revenue growth, close to 12%. Again, this has been pretty consistent over the last couple surveys we've done. I always like to throw in that caveat, since last summer when inflation really started to spike. Obviously there are some impacts in that number of inflation because, as we know, talking to these companies throughout the survey and just even more qualitatively, a lot of them have been taking their own increased costs of doing business, their raw materials, their own, and just passing that on to their customers. So, of course, as a result, top line revenue will grow as prices and rates start to go up. But we also see that there's, some significant expansionary activity going on as well in terms of producing new products and services, entering new markets, building new facilities. So those activities then indicate, there is an appetite for growth.
It's not just tacking on the extra 10% of their products.
Yes, correct. It's not all artificial. We do acknowledge there's a portion of it that's due to inflation, but there's certainly a lot of organic growth happening as well. You compare that to the S&P 500. So we've been doing this for a number of years where we, think about, okay, how does this compare to large businesses in the U.S.? They've grown at 4.8% over the last year. So this is, again, comparing back to the last 12 months. And then if we think about the rest of this year,
sorry, I want to interrupt you just for a second because right there was really important is, we'll link to this in the show notes, Doug, is like when you're the Market That Moves America document, like, because it's just really to your mission. Think about it. Like the middle market's growing at 11% and they employ, like, what does it say in here? It's like what is it? There's 200,000 middle market companies and employ how many people? And it's growing at 10%. Like, this is a big deal. When I think about like Yellen and Powell and all these people talking about inflation, and they look at like Amazon, Meta, and all these people, and like look at the S&P 500 is slowing in growth and employment is slowing. Yet here's the middle market just screaming upwards in double-digit growth. And it's half the population of the working people in America. So it's like, it's a big deal. And I think that we're seeing how big of a deal the middle market is, Doug, inside of the inflation numbers, in my opinion.
Yep. Absolutely.
So, okay, sorry to digress, but you're going into employment growth.
Yeah, great observations. I sometimes gloss over those, stats to remind people about the importance of the middle market, but you're spot on. It's still, I think, grossly underestimated and ignored when it comes to kind of overall U.S. economic performance. But again,
and I think we're seeing that because, I think that's my point is, yes, that's obviously your guys' mission, but we're finally seeing how important it is because if Powell can't, get to that target 2% because we're not addressing the middle market, everybody's looking at the people that like we think are indicative of the whole economy. And I just think it's just a proof, which is good. Okay. Sorry. Moving on to then employment.
Yeah. So employment, this one's been interesting because even going way back to, I'm talking like 2015, employment has always been a significant challenge for mid-sized companies, finding enough people, finding the right people. And they're fighting, right, against small and large businesses. So when we see numbers like 10% employment growth, 10% projected over the next year, I always, in my mind, wonder, are those numbers and that type of growth actually achievable? Because we know there's this significant issue when you look at, still historically low unemployment, the things that the Fed is doing, it's kind of speaking to, things that they're trying to do to bring that inflation down. But in fact, employment kind of continues to rage on, and the middle market is no different.
Yeah. Yep.
And then similarly, we compare that to small and large versus some reporting that ADP puts out, which is a headcount based report. But again, it serves as a nice proxy. And just like revenue, I mean, the middle market is kind of blowing away the growth in both of the other two categories of size,
which are 1.4 for small and 1.6 for large compared to 10. Right. And I just think, again, that is so dramatic, Doug. And what's fascinating, and I don't know if you guys dive this further into the data, is like when I think about like the income statement and balance sheets and cash flow statements that we see inside of, one of the biggest hindrances to the mid-sized marketplace is, can they afford the engineers and the people? I know that you got another study that we're going to talk on for a couple minutes, but can they afford the people that they need to invest in at the same time, especially as wages need to go up for people to pay for the cost of living? It's like the middle market is almost like this pinch point that I see. And to your point, I think is validating, can we even achieve the gap that they want to hire for? Yeah.
So we looked at, to your point, we looked at that a little bit to see, it's kind of jumping ahead to some other comments I was going to make, but how are companies dealing with this macroeconomic environment, the war for talent? We're seeing things like offering, retention bonuses, wages certainly going up. I think the average right now is about 6% increase across mid-sized companies. So they're reacting in those ways because they have to in order to keep people. And it's critically important, is going to kind of continue to affect their own costs of doing business.
Mm-hmm. All right, we can come back to that in a second. So then you got capital investment, which I found was an interesting shift.
Yeah. It's we've been asking this question since the first time we fielded the MMI back in 2012. We ask it in a kind of an interesting way. We say, if you had an additional dollar of revenue, what would you do with that dollar? So 6 out of 10 companies are telling us they will invest. I think this is still lagging somewhat behind the performance. The reason I say that is, pre-COVID, we saw investment numbers that typically were closer to 70%. And now that we continue to remain in this environment of a lot of uncertainty, certainly inflation, will there be a recession? I think, there's still varying opinions out there. Is it going to hit? Will it even be severe, or how long? So that creates, some pullback and hesitancy when it comes to this investing. But again, 6 out of 10 companies tell us that they're putting that money right back into growing their businesses.
Do you want to give us what I found is cool is on the expansion section, of where they're planning on putting that money and how it's actually grown significantly over the last few years, since even 2019.
Yeah. It's surprising from survey to survey. A lot of times the capital destinations might change. In this wave, we're seeing things like, again, building facilities, plant and equipment. We're seeing investment back into people, not only in hiring and wages, but also in the form of training. Because as I mentioned earlier, sometimes you just, you're hiring people that don't necessarily have the right skills. And so they have to be trained and skilled up and kind of addressing those gaps. We're also seeing quite a bit of, this is interesting, and this kind of touches on some other work we've done earlier this year, but investing in technology. We've been looking at digital transformation now for a number of years, and this seems to be an area that's just going to continue to excel. And particularly as more and more of the large service providers have come to the realization that middle market companies need a more scaled and a more affordable version of these technology platforms.
Right.
As that shift starts to happen, more and more businesses are going to invest in these areas. And it's certainly going to help do two things. One, drive productivity and potentially lower costs, and then also address some of that human capital issue and human resource issue that we've already talked about a bit here today.
Super fascinating, Doug. It'll be interesting as we watch your data over the coming years. I had this gentleman on the podcast where we were talking about AI and AI productivity for companies. And his whole deal is really shifting the narrative around, instead of doom and gloom of firing people, is like, we actually need AI to boost productivity as the boomers are retiring. And like, so his whole deal is like, can we get like 3 times the productivity out of our current staff than without hiring? So it's not like a negative, it's a positive growth. And be interesting as we watch these numbers, how productivity and employment and revenue all kind of track with the AI movement.
Yep. And we wanted to ask about AI as well. So I would say there hasn't been an event, a conference, a presentation that I've been at in the last 6 months where AI hasn't come up. And so in this wave, we put in a couple of questions, pretty high level, but to get a general sense, like, where does the middle market stand on this right now? I think the light bulb is coming on. More and more companies are getting curious about it. We ask, like, current state, are you looking at it? Are you testing it? Or are you actively using it? Only about 10% of the companies are actively engaging in AI in different parts of their business, but a significant majority are in some area of exploration and or testing. So we know this is going to happen. It's not a question of if, but when. Yeah. And to your point, I think there could be, some of the significant challenges these businesses face can be addressed by smartly using these types of tools.
It'd be interesting too, as you track that, Doug, is that one of the big reasons I believe that it's only 10% using it now is this whole like data security of like, you can't go into ChatGPT. The guy I was interviewing, his name is Lauren, for the listeners, Lauren Harsagro, and I interviewed him. He was like someone from like, I think it was Samsung or a public company, put their like board share minutes in there, their shareholder minutes in there. And it was like, holy cow, now it's actually live. So I wonder if it's like people are, actively working towards it, but they're doing it more in the private network setting. Until they're actually, which takes a little bit longer.
There are some, from some of the experts, I'm certainly not an expert in this area. I'm not a technologist, but from some that I've heard and met with throughout the last couple months, it sounds like there's some really big fundamental issues to solve with this. One of which you just talked about, intellectual property, right? Like, who owns this stuff? If you're out in these ChatGPT environments, it's my understanding that that's not your property. It's like kind of like public domain. So it's going to be really fascinating to watch over the coming months.
Likewise. Yeah, I totally agree. All right, let's keep going. And then the next section is
confidence. Yeah. So, we look at 3 different levels: global, US, and then local. This pattern is certainly not surprising. It's remained almost entirely consistent over the 38 times we've done this survey. Local economic confidence, always the highest, because that's where middle market companies operate. It's the area that they know. They know the people, their suppliers, their customers, their employees locally. What does encourage me about this, though, is despite all of that uncertainty out there in the macro economy, these numbers remain pretty high. Close to historically high in terms of all 3 levels. So, that is a indicator of kind of future confidence in both performance, growth, and those types of things.
Like, you literally have, I'm looking at the chart. It's like, it's the same almost for local as it was in 2019.
Yeah, right.
Global. Okay, I don't know what's going on here, man. Like, I must be living in a parallel universe, but global economic confidence is higher than 2019. Maybe people are seeing stuff that I'm not, but that's a good thing. And, I think it maybe is feeding the narrative. Like, these companies can control their destiny in their local markets and in their national presence. And it's maybe more, is it, like, what would you attribute?
Yeah. Well, that to? So you think about a year ago, it was, these numbers dipped quite a bit. We had inflation started to hit last summer and spike kind of out of control. We were, 9-10%. You had the war in Central Europe. So that affected a lot of that global, because again, when people think about the global economy, a lot of times that is looking at the news and thinking about geopolitical events that are happening around the world, largely out of their control, right? So you're getting influenced by what's happening in Europe, what's happening in Asia, what's happening in these areas. And then, locally, it comes down to kind of like what's happening in your backyard and things that are outside of the management team's control, but again, certainly have an impact on the business performance.
Well, it's encouraging, which I think is actually showing up then in the capital investment area, which it goes back to what you said. Like, I mean, the fact that people are willing to spend the dollar instead of save a dollar is kind of the people judge with their wallet.
Yeah. And and it's interesting given the fact that compared to a couple of years ago when money was essentially free, right? Our interest rates were close to zero. And now we're up in that 6-7% range. We do ask a question every survey because I've had this posed to me like, hey, how are these middle market companies thinking about access to capital? Less than 10% say it's a problem for them. Now, that number may change between now and the end of the year. We're certainly going to keep an eye on it. But for most businesses, at least they feel right now they have the access they need, but it certainly comes at an increased cost, right? If they're taking out a loan or a line of credit, that cost to them is a lot higher than it was, say, 3-4 years ago.
I agree, but I think, which makes a ton of sense too, Doug, but I also think like the whole cost of capital shenanigans is never really ingrained in the middle market playbook anyways. It's like we need to, when I speak to Vistage, I always say, Doug, like the difference between the middle market and the public markets are the middle markets have to generate enough cash flow to pay their payroll and pay taxes, where the public markets can just move some different things around and do their accounting tricks. And their goal is to then just continue to fuel their capital need. And if they're fueling capital, or if the fuel is capital, incremental cost makes a big deal. Well, in middle market, it's like if you're going to build a plant every now and then or one acquisition every now and then, you're going to look at the interest rates, but it might not fundamentally change your strategy. I don't know if you see that as true or not true, but
I think you're absolutely right. Yeah, the I guess the purview or the long range planning mentality of these companies a lot different, right? They're not thinking about the next quarter's earnings report. They're thinking about 3, 4, 5 years down the road, right? A lot of those considerations do tend to be quite different when evaluating, the need and the use of capital. So I 100% agree.
So as we wrap up, you got your key internal and external challenges. What are some things that you think we should be thinking about before we have you on next?
Yeah, I mean, so that's always an interesting area. The things that we see popping up that are kind of keeping a lot of these executives up at night. Yeah, where is inflation heading? I mean, it has improved significantly over a year ago, as we all know. But is that going to continue to go down? Potential recession, as I mentioned earlier, how does that impact, not only my own business, but my customers and my employees, and how do I have to react with wages accordingly, cost of living, those types of things. It's the other thing we asked about, just one or two questions about the banking crisis that happened, the mini crisis in the spring.
Yeah.
And, surprisingly, it spooked a lot of these companies. They ended up, maybe moving some of their money from one bank to another. Some of them told us they bought additional FDIC coverage. I mean, I think it was just kind of a scare that sent a kind of a short shock wave through, but it appears that we're past that. So I would say that's a lingering concern. The talent issues are always the kind of the evergreen topic, right? And we've touched on that already a little bit. So I think those are going to be the big things, as we get through the end of this year. How to address those. And then, certainly the technology question, because it's easy to say, yeah, sure, you need to invest in technology. But a lot of these businesses come back and tell us, that's great, but where do I go?
How?
Who do I talk to? Where's the smart place for me to invest? They kind of need a roadmap or a playbook, right? And so that's where we say, like, look, you might not have that expertise internally, but there are a lot of advisors out there that can help you down that journey. So you really need to find those, just like your banker, lawyer, accountant. You need to find a trusted implementation partner that can walk you through those steps.
Yep. And I will say on the AI, for the listeners, we'll link to that Lauren Horshager podcast. And then Doug, as we wrap up here, what are you polling when you're doing this survey? Like, because I think the listeners would be interested, like you said, how people are handling and tackling the technology, but also like this staffing and the labor. Like, if you're at any given point finding interesting strategies that people are deploying, like internal training or how people are handling this labor and skill shortage, I think would be a fascinating topic that our listeners would care about next time.
No, it's a great question. I would say we don't necessarily survey on that, but we do a lot of conversations around that. When I'm at, middle market events or I'm on the road and I have a chance to meet with CEOs and owners, that's one of the things I ask most of these individuals is like, okay, we see in the data that there's a challenge. What are you doing individually or collectively to address? I mean, I think over the years, we've seen some creative things that companies are doing. Sometimes they're collaborating with peers in even within the same industry. And they're saying, if we come together, let's say we need a certain skill set, I don't know, welders or engineers or something like that, can we work together to address that collectively rather than one-on-one, where it becomes much more of a challenge? I would say even being at Ohio State University, we're kind of facing this right now because we've got the big Intel investment. They're building a huge, microchip facility about 20 miles away from campus. And they've already come to us to say, we're going to be hiring hundreds of your students every year. So one, you need to be ready for that. But two, you need to build curriculum so that they have the right skills to come in and immediately make an impact. So that will apply not only to Intel itself, but the hundreds of middle market suppliers who will be co-locating around that facility.
Interesting. Yeah.
That's kind of that's something that's happening in our backyard that I'm taking quite a bit of interest in, because I want the NCMM to be a part of those conversations with all that supply base. They're going to be middle market companies, I can guarantee you.
Well, and it goes back to one of the segments we had in here about the growth of e-commerce and it's just about making sure that all the labor and the companies are moving to where the puck is, which is the point of these segments and having you on. So, Doug, this has been an absolute blast again. Where can people find the National Center for the Middle Market, the reports, and subscribe to you guys' material?
Yeah, the nice thing about our center is that all of this information is publicly available. Go to our website, middlemarketcenter.org. You can also subscribe there. Very easy, just your name and your email. You'll get regular newsletters and updates on all of our latest research, our data, our events, and outreach. So that would be a great place to start.
Doug, thank you so much for coming back on the show.
Yeah, glad to be here. Thanks for having me.
All right, we're halfway there. If you're just listening to this in one long string of audio, I give you a ton of props. But if you're just skipping to this, I'm excited because we are going to be diving into the merger and acquisition deal volume, valuations, deal structures with Jeff from ButcherJoseph. And the reason I'm so excited about this part of our quarterly updates is Jeff is one of the managing partners at ButcherJoseph. They're an investment banking firm that does a lot of deals in a lot of different structures. So it's not just a one-trick pony of someone that sells a company to a third party. They do debt raising, they do internal buyout transactions, ESOPs, sales to third-party strategics, as well as private equity firms. Jeff is on the board of the National Center for Employee Ownership. So if you caught last week's episode when I was talking to Corey Rosen, they're in the same circles with the National Center of Employee Ownership. So Jeff is just trying to help us understand what's going on from the valuation perspective, given the state of the economy. So where they get their data is not only from their own transactions, but they leverage a tool called GF Data, where they are getting data from 400 plus private equity firms that are submitting their deal data between $10 million and $500 million in enterprise range value. So Jeff's going to be talking about, is the deal volume up or down over this last quarter? What's going on with multiples? And then we dive into what's going on with the different industries, which is related to ITR's segment because the different industries are in different cycles. So we start to see different data show up. And then what's happening with financial premium performers, whether people that are in really good rock solid shape, or if they're getting a premium or not. And then what is happening with senior debt, interest rates, platforms versus bolt-ons. There's a lot of material that Jeff and I cover. And I think given the first two segments, there's going to be a lot of context for this conversation with Jeff. So without further ado, here's Jeff from ButcherJoseph. Jeff, how are you, my friend?
I'm great. Ryan, how have you been? Hope you had a nice summer.
Yeah, right. It's like,
Anyways.
it's like it was there and now it's gone, and that's
Yeah.
I don't. Yeah, that's how it typically feels in Minnesota, because we jam 12 months of fun stuff into 4 months and just hope for the best, and then get back to work when Labor Day hits.
Right.
And we've not only had a crazy summer, but also on our last call, we were talking about interest rates and the bank failures and all these different things. And it's just amazing, especially I know ITR, the folks that Brian loves talking about, how just the flash in the frying pan of the news kind of forgets that there's this underlying trend and things that continue to move forward, whether the news talks about it or not. And you had, right before we had hit record, you'd said, observing some of the trends and the velocity of those trends. What were some of the things that you're kind of seeing that are sticking or that you're observing right now, Jeff?
Yeah, I mean, I think if you think back to a quarter ago, we had already sort of established in the first part of this calendar year that we were coming off sort of a kind of a high water mark at the end of 22, right? For deal activity, volume wise, for pricing multiples that were being paid. And we recognize, I think, in the first quarter of the year that we started to see a little bit of a reversion downward, both in terms of pricing multiples that were being paid and starting to see maybe a little bit of a slowdown in deal volume. I think the velocity has only sort of continued further and maybe even sort of picked up steam a little bit in the second quarter, unfortunately. Because we definitely saw a continued reduction in deal pricing, particularly at the high end. When I mean the high end, I mean the largest transactions.
And by pricing, just to be clear, because you're talking total enterprise value, but specifically on the multiples.
Correct.
Okay.
Yes. Yeah. Thank you. Generally, when I say pricing, I sort of default to thinking everyone knows what I mean, but it's good to clarify that.
It's all good.
Typically, pricing of a enterprise value to EBITDA multiples. So EBITDA multiples have sort of continued to decline. Throughout the second quarter, maybe even picked up a little bit of steam. I think that as a result of that, consequently, we saw a lot of volume further deteriorate. And I think where we are now in terms of sort of deal volume, if this sort of trend continues through the end of this calendar year, we'll probably be at the lowest mark for deal flow and deal volume probably for the last 4 or 5 years.
Yeah, I was gonna say, do you remember what the numbers were? Because I mean, it's pretty significant that, I mean, it's not just, a couple deals fall off. I mean, I don't know what the percentage is or whatever, but I mean, the new interest rates and a lot of the stuff, I think, is starting to come into the system.
Yeah, exactly. There's just the ripple effect of a lot of moving pieces in prior months, right? I think where we've seen the most price sort of deterioration for the largest transactions, as I was starting to say, there's certainly been some price deterioration for the smaller transactions, but those smaller transactions never kind of, I think in my mind, sort of experienced the same sort of run up in pricing that the largest transactions did. So proportionally, there was more downside, further for the larger transactions to fall versus the smaller transactions. They just didn't have that same sort of run up. But a lot of it, I think, is due to the fact that the pricing environment, particularly for financing, has just continued to increase. I mean, we talked about it before. The Fed started in early, 22, and that certainly continued throughout the course of calendar year 22 and into 23. Hopefully, we've seen that the rate of increase has slowed on a more permanent level. I think everyone's kind of anticipating that the Fed might raise rates a couple more times this year.
Maybe.
Yeah. Maybe 25 basis point increments, which is still, raising rates, but not to the extent they were when they were raising them by 50 and 75 basis points. And that 50 and 75 basis points obviously has created just higher cost of financing that sort of rippled through. And with that higher cost of financing, that's resulted in these lower pricing multiples. It's created an environment where maybe sellers of businesses and buyers of businesses are kind of having a harder time reaching a agreement on value. Maybe the appetite for selling your business is still there, but the spread between, the bid-ask spread between what someone expects to get, what someone's willing to pay might be a little larger. And that just creates a little bit of a slowing of the wheels of deal flow and the progression that things go from start to finish. I think banks, as part of their sort of diligence process, are Obviously, because of the sort of some of the uncertainty perhaps on the horizon from a macro perspective, and trying to understand and digest how rising interest rates are going to impact businesses, or doing some additional diligence, and that takes time to get your financing lined up. And so a lot of these things I think are responsible for kind of where we are today. As I mentioned, what we sort of saw in the second quarter for the increased velocity in some of these trends.
Well, it makes so much sense, Jeff, because every graph that I've seen over the last 6 months, of the graph between when Volcker raised the rates and then, or Bernanke or any of these people, it's straight up on how fast they raised them these days compared to even when Volcker raised them. It was more of a 45-degree angle, and it's just going to take some time, because I always think to myself, whether you're in a huge deal, you get your bank financing of, even it's 8 figures, 9 figures, you get your bank financing, due diligence, the whole machine's going, and that's happening halfway through the deal. So now, are you starting to see where the new landscape is impacting the origination of the first conversation, almost where we're kind of caught up now, where the stuff that was in the funnel is kind of being reconciled with, and now it's kind of hitting the prospect of new deal flow?
Yeah, I think we're starting to maybe see a little bit of that. I think that our thoughts and perspective at this point are that where we might really start to see some more progression in new deal flow in the broader M&A market might be sometime in fourth quarter or first quarter of next year.
Got it.
We're kind of at this point. August is always kind of a weird time too, right? Because in July and August is usually the summer months when people go on vacation, right? So you get a lot of people that are out on vacation, their attention is elsewhere. And so they kind of put things off a little bit until they get back from vacation. Kids are starting to go back to school. Labor Day is this coming weekend. And so maybe, traditionally we've always kind of seen maybe, I don't want to say the floodgates open post Labor Day, but we see just a little bit more attention to transactions given by people post September. And so maybe I'll change my mind next week or 2 weeks from now. But as we sit here today, I feel like where we kind of are is at this quiet period that I feel like might continue to linger into the fourth quarter. And then maybe that's when we'll start to get really some legs behind some new deal flow from there and into the Q1 of next year.
It'll be interesting to watch the volume track along with ITR's the business cycle, where they're predicting a slowdown in 24 and more of the growth in 25. Because this is just my layman's way of thinking about it, but all of those rate hikes are now coming into fruition in 24. You know what I mean? It just takes that while. And then 25, we're starting to get into the new world, and all the expectations are kind of aligned. I don't know. It seems like a sensical argument, from a narrative perspective.
Well, and and the other thing I think that we're seeing too that kind of plays into that is a lot of companies, they're coming off a fiscal year where, let's just say they were at peak earnings, right? And peak margins at the end of 22. And so now, as people are buyers of businesses and sellers are talking, and those companies are producing financial statements, we're seeing some financial statements that are showing kind of a decline from those peak earnings. And so I think, again, a lot of times in the diligence process, people are really spending extra time trying to understand, well, is this a structural change in the underlying business's financial performance? Is it temporary? Or how, if we see kind of a decline in the earnings, when do we think that decline is going to stop and stabilize, and at what level do we think that's going to be? And that's kind of what everyone's sort of looking for and trying to get their arms around. I feel like is, okay, we get that you're coming off peak earnings, but what we don't get is how far below peak earnings you're going to go. Well, and we got to get comfortable coming off those, to what that level is before we're willing to really move forward with greater, speed. So, and
I'm assuming you're having this with your clients too. And as my team's having conversations with our clients, and we're trying to get to that, what's the new norm, it's like, well, we got geopolitical issues, we got supply chains that have decoupled and are not going back. So like we're trying to like pin it back to some sort of normalcy, but there is no normalcy to pin it to because it's like supply chains are different, interest rates are different, geopolitical issues are different. And then I'm watching from our various industries and sectors that we work with, Jeff, the softening of sales too, which you talk about, like you might have the peak earnings because of the free money, but then like the consumer doesn't have the dollars to spend. So there's just so much swimming around in what's normal and then what do we project into the future.
Yeah, exactly. And everybody's just trying to get a better sense of kind of what that looks like and where, if this is the bottom and, or how far the trend is going to continue down. You don't want to catch sort of that falling sword is the old adage, right?
Right.
So just kind of, those types of trends, I think you're right, is what's causing a little bit of consternation and slowdown until people can kind of get a better sense of, where things will shake out and why. And
I think that kind of concept showed up. Do you want to explain the financial performer premiums? I thought that was a interesting concept, and how there was financial performers that had a premium and that premium is declined. So maybe kind of explain what that is and the importance of that premium.
Yeah, absolutely. So conceptually, financial performance premium generally, kind of what that's referring to is the incremental premium a company that would be viewed as a high performer would receive in a transaction relative to maybe a company that's considered a lower performer, right? I mean, the idea simply in a nutshell is that, hey, if you've got a company that is a high performing company, that's in greater demand than a lower performing company would be. And investors and buyers of businesses are willing to pay a higher price because you have and can exhibit those characteristics. But with everything sort of resetting and recalibrating, largely, centered around the amount of debt that's available, when, you're underwriting these transactions, while you might still be willing to pay up for a premium business relative to a lesser performing or an underperforming business, the ability to pay as high of a premium is that much more difficult.
Got it. That spread is just...
That spread is compressed, right? That spread is compressed unless the buyer wants to put in more equity and preserve that spread. But the challenge is for financial buyers, to generate the type of rate of return that you want to generate on your investment for your limited partners. You really sort of need to minimize the amount of equity relative to debt financing. And so, it gets a little challenging just from the math equation to be able to continue to offer that same type of premium. So that premium is compressing as a result.
Super helpful, Jeff. And then also maybe another layer of context to that is the bolt-on versus the platform and kind of what's going on in there too. Because I think these are just wonderful ways to highlight the trends that you had just started off with.
Yeah, absolutely. I mean, we're seeing, I think, a trend where, again, if a buyer was to establish, a sort of a platform business, they're going to view that investment differently than what they might view, of course, a transaction that would acquire another smaller business that they would bolt onto a platform business. And interestingly enough, I think lenders are doing the exact same thing, by the way. One of the things we've seen in some of the credits, we're out in market, all the time with some companies. And one of the things we're seeing in the responses we're getting from lenders is that they don't feel they can be as competitive as they would like to be for a business that they are not already the incumbent lender to. If they are the incumbent lender, they're willing to kind of stretch a little bit more beyond what would otherwise be the case because they're already familiar with the business.
Yeah, they're known.
Right?
It's familiar.
It's the devil you know already is better than the devil you don't know. And I think the same type of concept is kind of playing out a little bit in the sense of these platform businesses, bolt-ons, in terms of how buyers are going to be looking at those and how much more they're willing to take a leap on. Clearly, if you've already got a platform business, you want to continue to build that business. And so you may be a little bit more aggressive with the platforms because you want to continue to build that business, particularly now if the organic growth of the platform business starts to sort of wane. And you can obviously buy inorganically another company to bolt on to it to further scale the business, which generates, not only incremental dollars, but maybe, some synergistic value that also helps,
right. And
margins.
And all the synergies, then also the bigger the cash flow, the larger the multiple just in general too.
Yes.
And so in the last kind of question in this, the line of thoughts is, and then how are the different buyers reacting to all of these components too, from family office to private equity to strategics, knowing that the premiums are kind of coming down from the financial versus the strategic, like you alluded to?
Yeah, I think that's a great question, and I think there is a sort of a stark contrast in those particular cohorts. I think the strategic buyers are all going, "Thank goodness."
Totally, yeah, right.
Thank God, we finally have some sensibility in the marketplace, because they were a lot of times priced out of the marketplace 2-3 years ago when private equity was paying multiples that they felt were astronomical, for lack of a better word. And so now that we've seen those multiples come down, they're a more competitive buyer again.
Yeah.
And so they're looking at this going, "Phew, thankfully the market's reached a sense of sensibility." I think private equity is the one that's probably had the least activity levels this year as a result of the fact that they just use leverage so much in their transactions.
Mm-hmm.
We already kind of well established what that means for pricing multiples. And so I think they too like the idea that they can pick up businesses today that are high quality at a cheaper price than they had to pay 3 months ago, or 3 years
Mm-hmm.
ago, I should say. So I think even they are kind of applauding this. But I think they're the ones that also recognize a bit of the frustrations that it's, again, maybe more centered on just the amount of capital that's available for them to capitalize on opportunities,
Mm-hmm.
more so than anything else. Whereas strategics usually, they have a strong balance sheet, they have cash flows, they can maybe sometimes pay with equity as a form of currency. They built up cash over the years, maybe they have a greater war chest.
And they probably have their assessment of risk. They're in the business that they're most likely buying a general good chunk of the time. So then there's the ability to get the deal done because they can see the risk in a little bit different fashion too.
Exactly. And of course, the private equity firm is going to have a little bit of a shorter investment horizon. So it's very important to them to that their entry price be a certain amount, that's at a certain level. So the exit result that they're anticipating and driving for creates that sort of, value for the limited partners. I think family offices kind of a little bit of a hybrid there. I would say more probably skewed toward a strategic buyer than private equities, because they have a longer hold period.
Mm-hmm.
Obviously, clearly still a financial buyer in a lot of ways. But I think that, there's an opportunity for family offices to kind of look with their longer term horizon as at a portfolio, at a business, and think about it from, well, how can we sort of help the management team build this business up?
Very nuanced question about this. I just honestly, my own curiosity, Jeff, strategics, higher probability, most likely getting cash up front, maybe an earnout, escrow, some stock swap. Private equity, traditional cash, maybe some earnout, but rolled equity. Family offices, I've interviewed quite a few family offices, Jeff, and the ones I've interviewed, not to say that this is a general rule for all family offices, but they didn't like to have they didn't like mathematically for their investment thesis to have the rollover equity, because they're like, well, we're going to buy the rest. So why would we want to pay more later? So the private or the what I've interviewed and from all the family offices I know, they kind of lean more towards the strategic from the deal structure side. Does that reconcile with what you see, or?
Yeah, I would agree with that. I think that's a fair point, because again, the mindset of the family office is more akin to the strategic buyer.
Right.
Where they're not looking for a quick flip on the business. They're holding it for a much, much longer period of time. And so to that point, if I know I want the equity of the business and I think it's going to grow, why do I want to take a second bite of the apple after
pay more? Yeah, exactly.
No, I should get it now.
Right. Two things I'm kind of just paying attention to. Curious on your thoughts. Don't have to give any novel answer unless you got some comments right away. But I caught in the data that there's a lot more deal volume happening below the $10 million enterprise value that the GF data and you guys have been monitoring, which kind of goes into the what I watch in the U.S. Census Bureau. How many companies are below that dollar amount. It's like 95% of companies, yet you've got this $1.5 trillion of equity raised by PE firms and all these people. And so how, like, where are these deals going to come from? You know what I mean? Like, it just doesn't make any sense. So like, are these buyers going to have to continue to move down? My question is, Jeff, with this huge inventory of companies below the threshold that's even being tracked by the private equity data, and all of this money raised where you could go buy probably the entire private market twice, what the heck do you do about this? And again, you don't have to, I'm just so curious on this, how to solve this.
Yeah, well, I mean, there is a lot of businesses that are, smaller businesses out there, clearly. And there's a universe of buyers that are looking for smaller businesses, and the credit markets aren't closed, right? So there's still financing available, and commercial banks, if it's a business that has some assets that can be lent against, there's still some credit there that facilitates, transactions in that smaller universe of companies, for sure. I think that's just always going to be, though, a different type of buyer versus the buyers of businesses that traditionally focus on the larger companies. So I don't think we're going to see a circumstance where someone that traditionally has looked for a $200 to $500 million business all of a sudden saying, well, since that deal flow has basically frozen, I'm going to go buy a $20 million enterprise value business. I just think that's not going to be, kind of there.
Do you see the possibility of having more and more like holdcos or like the permanent equities? I don't know if you're familiar with Brent Beshore. He's been on the show a couple of times, where these people are like more active in the operations, because the smaller you get, the more active you have to get in like maintaining the asset. Yeah, no,
I think there's a big group of people out there, buyers, in that universe of companies that recognize that those are, these smaller owned businesses oftentimes don't have like a real built out leadership team, right? They didn't establish like a deep bench of leadership. They don't have really any sort of plans for ownership succession. And so it's a universe of companies that are ripe for someone to come in who wants to have more of an operating role. Right. Not just be sort of a passive investor, but independent sponsor, maybe someone that can come in and really put themselves in the CEO seat, and drive performance on a go forward basis. I think is certainly
I think we're going to see more of it.
We'll see more of, yeah.
Jeff, this has been an absolute blast again, as always. Lots of rich, valuable content. I appreciate your time. Is there anything that we should be thinking of between now and the next call, or something that you're kind of curious on that we should pick up next time?
I'll be just curious to see how companies' earnings performance hold up through the rest of the second half of this year. That's the biggest thing I think I'm keeping my eye on, because I think that'll inform a lot about the sort of activity levels that we can expect in 2024. I think everybody pretty much has a good sense of like the Fed's path, barring something that is, unexpected. And you can sort of underwrite to the type of environment we're living in with the cost of money. But I think the unknown variable, at least right now, is just how companies' performances will hold up. So we can focus more on that next time.
Free cash flow and earnings, baby.
Right, exactly.
Jeff, thanks so much for coming on the show again.
It's my pleasure. Thank you. Thanks for having me.
And for our fourth and final segment of the Quarterly Economic Update, I have Jeff Campbell from AiCommerce. And the reason I had Jeff on the show is because Jeff is a professor, so he helps teach people about marketing and business, which I love. He's also an entrepreneur. He invests in companies, and he helps e-commerce brands expand their marketplace across various platforms. So I got an email from Jeff, and it showed all the data, what's going on with retail and e-commerce, and I couldn't wait to stack him onto this quarterly update. So Jeff is going to be diving into what's going on in retail sales, and then specifically how e-commerce and mobile commerce is impacted and what the growth rate is compared to physical stores. And I think this is all very relevant based on the part of the ITR segment where we were talking about retail sales, the consumer debt, and we're just jumping right into specifically that segment, where Jeff highlights the different trends and what to expect with Gen Z, and how Gen Z is going to be going from like 40 some million consumers to 60 million, and what that might impact mobile sales versus retail sales versus e-commerce, and how the different platforms like Walmart and Amazon and those e-commerce platforms are getting impacted. One of the interesting stats from today is that Amazon's in decline compared to some other different trending growth platforms that I think are some things to take note of. So without further ado, I hope you enjoy this conversation with Jeff from AiCommerce. Good morning, Jeff.
Good morning, Ryan.
I'm very excited to have this conversation. I was just saying to you, kind of giving you an overview of the quarterly updates that we've been doing, and you always, I actually read your email that comes out. So like there's a positive, good, right? And so it means you're providing value, my friend. And so much that I was excited to have you on for the quarterly update because of your focus on online and retail sales. And so why don't you just give the listeners just a quick overview of yourself and then the business, and then where are you getting this data, and then we'll jump right in.
Yeah, I love it. So my main company is AiCommerce. We are a digital marketing agency that's focused on retail media and marketplaces. So we'll talk a lot about that world. My background is 20 plus years in digital media, and we'll talk about plenty of that as well. I'm also a professor, adjunct professor at Wake Forest University, and teach digital media and marketing in their master's program for digital marketing. So just graduated our first 4 in that program and have a course starting this week with 25 more folks. So got to stay on those trends and keep up with teaching. I just love to make sure people are well informed here.
That's awesome, man. And it's so aligned with everything that we're doing too. So let's break down why you care about retail and online. So it's kind of give us the big overview of like why you care. And then, because again, with this segment, we'll have the economic update with ITR already with the kind of the macro picture. So it's going to slide right in perfectly.
Yeah, I love it. So let's start big at overall retail store sales. And it's been wild, right? Post-COVID, then we kind of had a bump. Everybody missed going into physical retail. Right now, where I'm getting a lot of my data, I love eMarketer. And so I'm using a lot of that in their 2023 U.S. e-commerce forecast that was put out in the last couple of weeks. So great data there in terms of, it covers overall retail sales, online sales, and then kind of the growth areas around marketplaces. And if you think about e-commerce, there's really 3 areas where you're going to convert a sale online, at least. And that is your website. Very popular in the past, usually number 1. Social commerce, which is growing fast, and social is still the number 1 place for where consumers discover new products. Great behavioral targeting that you can go and get your ad, your video in front of. And third is marketplaces, and we'll talk a lot about that, but that's really where people are going to buy. That's kind of the bottom of the funnel. The prime guy, comes every other day. I know him by first name. Actually, there's a whole bunch of them that come by. I love their return policy. They've got my credit card. That's where I'm making purchases. And that's a big shift over from websites. But as a consumer, I don't want to give them my email address. I don't need any more email that might not add value like mine, Ryan. I don't know their shipping policies. I don't want to enter my credit card or go remember that 3-number code. So I'm just going to go with what I know. So a lot of people just default, and we'll talk a lot about that.
Did you just sum up my shopping experience? And
yeah, right.
You just summed me up right there. Like, I don't want to buy from Amazon, but everything you just said goes through my head, and then I go to the app and I hit buy.
Yeah, I know it's tough, right? The devil you know. But overall, retail sales are growing, which is pretty neat to see. It is modest growth. You're looking at 3 to 3.5% growth in forecasted overall retail sales. And we've seen some higher prices, groceries making all the news, interest rate hikes, and just swings in consumer confidence. So it's holding back a little bit. We do see physical retail purchase sales growth closer to 2%. And in the US, about 85% of purchases are done in physical retail. So that's somewhat surprising to me.
I was going to say, man, it's like, everybody talks about online, and we're just all staring at our phones all day long, yet you got 85% of the sales in stores.
And that'll shift, right? I think that Gen Z is going to drive a lot of change. I mean, they're the digital natives, right? That's all they've ever known. They are growing from 46 million consumers in 2023 to 61 million in 2027. right?
It's interesting, dude.
And
When I was reading the report you sent me, I actually read in another article this week that they'll go right. So those numbers, to put some percentages to it, I think they're 15% of the workforce right now. And they're going to 30 by 2030. So like, it's a big deal.
Right.
I mean, what were the implications that you guys were? The implications of Gen Z to retail and e-commerce?
Smartphones are big. You mentioned it too, and I think we're all kind of in that digital space, so we act a little bit maybe younger than some of our cohorts. But smartphones are going to account for 43 of U.S. e-commerce sales this year, and then by the end of the year or next year, 50%. So really seeing those. And I remember having conversations or being in a conference. Raise your hand if you've ever made a purchase on your phone, right? And I'm dating myself a little bit, but now half of purchases are done on the phone, and again, Gen Z probably the strong majority. So
I think
that's going to be interesting.
One comment I wanted to hear from you, Jeff, is kind of just setting the stage for the listener about like omni-channel, where someone starts on, so people that maybe aren't familiar with e-commerce, but they start shopping on their phone, but then they actually purchase online or on their computer or in store. Right. How does that impact that mobile percentage you're talking about?
Yeah, it is. And, I mentioned the discovery with social, especially, right? You're scrolling through your TikTok and it's like, oh, I forgot I needed hiking socks or whatever it might be, right? But, and then you're bouncing over and you're searching Amazon, and then you might actually go into Dick's Sporting Goods and make that purchase. So attribution still is a big business, but you still have what we call in the industry are walled gardens. So a lot of the data lives within TikTok, and TikTok's actually come out recently and said, hey, we don't really love sharing, links and our customers with Amazon. So we're going to try and keep them in our world. Same with Amazon, right? Amazon's got just massive consumer data, and they've rolled out what's called a DSP, and that's using your behavioral data to go out on the internet and show you ads in different places, or selling more or less your behaviors to people that want to target you. So if I've got hiking socks in my cart, a competitor of maybe Darn Tough or whatever brand that might be can actually target me throughout the internet. And that's really strong data. Now you take that to the offline world and you look at somebody like Walmart. I mean, think of the throne of data that they're sitting on with all of their online purchases. And it's,
I think they got online and the stores, like they got the best of both
So you
worlds.
got store data. I like to buy trail mix to continue our hiking, and maybe some dehydrated, beef jerky, dehydrated food packs. And it's like, wow, this guy likes to hike. And Walmart can say, hey, you guys can target him online. And they have a great first party data network because they have my email address and they know I'm a customer, and they can actually tie that back to sales, including in-store sales. So I might be shown, I'm playing fantasy football and there's an ad for some new trail mix or beef jerky. And then Walmart's actually able to report back to that company that advertised to me via their platform if I actually bought that in their physical store. So a lot of
compared to what you said earlier. Compared to what you said earlier, where you scroll on TikTok, you see a couple things, and you go into Dick's Sporting Goods, and no one knew how that went down.
That connection's a lot harder, but do expect it to get better. In the TikTok example, they're adding, commerce. They have commerce. So you can actually now, you're seeing more and more brands testing out some of their advertising, some of their commerce abilities, where you can actually, have that full circle purchase and have shipping and e-commerce to you. Instagram is probably a little more recognizable, where you're scrolling and you see a product and there's that shop now, and you can completely check out without having to bounce to a website or a marketplace to make that happen. So TikTok is certainly doubling, tripling down in that area. And TikTok by 2025 is supposed to be the number one in user minutes across all the social platforms. So right now it's number 2 to Meta and probably really Instagram. But that is going to climb to number 1 in minutes of usage. So you gotta target all these places, and it's tough because, right, you got overall retail sales growing, you got online sales. They're expected to grow 9% this year and like 10.5%, 11% next year. And then you've got the marketplaces, and they're actually expected the highest growth overall next year, where they're closer to 11 to 13% over the next year. So growth online, which is great. How does a marketer pick their battles with their limited budgets and manage that portfolio?
And pulling from your email, you can elaborate on this a little bit more. You're talking about as competition increases, brands must increase spending on customer acquisition and increase efforts to retain existing ones. You want to explain the implications of that comment?
Yeah, a lot of e-commerce folks are not wrong, but wanting every sale to be profitable. And that's
welcome to entrepreneurship, right?
Right.
Sorry to
you need it. They're not wrong,
yeah,
but at the
right,
same
exactly.
time, and using the Amazon subscribe and save, right? Or if you've got a quality product, you've got a tea that you think the flavor is going to blow people away, you can lose some money on those sales, bank on your product's value that you're going to add. And remember, remarketing is important. Again, even down to advertising. I should have ad campaigns that retarget some of my current customers, my lapsed customers, and even a strategy around non-customers. So I can say, hey, this person hasn't bought from me in 6 months. How do I get them back? Or, hey, this person has, bought from me religiously every month, every couple of weeks. How can I, get new products, cross-sell and upsell to that person? So yes, customer acquisition costs. So think of like getting that customer and then lifetime value. And I always love to tell the Amazon story from like 2001, 2002, when they were just starting. I was an affiliate for Amazon, and they were paying me $50 for every sale I would get, regardless of the sale amount. And the AOV, the average order value, was like $25-ish. So I'm like, you're paying me $50 to get a $25 order? Like, this company is not going to last. I'll take your money and laugh all the way to the bank. And they're like, Jeff, we're doing this on a 10-year lifetime value model, right? We think our shipping, we think our customer service, we think, the marketplace is that valuable that you're going to keep coming back. They were right. Right. And I've spent, I'm sure everybody spent way more than that initial value, but I mean, that's a good strategy to think about. What is the, is this a one and done, or is this an ongoing relationship you're looking to have? So yes, I do think lifetime value, loyalty measurement's important.
And what I'm hearing in that kind of story is that it's the overall relationship with the customer, instead of a flash in the frying pan that you sold someone some sunglasses while they were scrolling on TikTok. You know what I mean? Like, right. That's what I'm gathering. I like turning these companies into real businesses with a real brand that sell on multiple channels, that are selling goods and services to people that want it.
Right. And you build that brand, and that's so important. And I think that's being lost a bit with marketplaces. Most people go to an Amazon and other marketplaces, anywhere there's third-party sellers. I mean, Macy's has one, and Walmart and many others, Wayfair, and it really is price. And that is another, I think, one of those implications of like really conveying your value to folks, and it might not just be price, right? And consumers are, typically going to go for the lower price, but if you've got strong ratings and reviews, good content, people are willing to pay up for that. If my kid needs, football cleats, and I can go on Amazon and I can find some no-name brands that, sound a little, Chinese or whatever, but they're half the price of Under Armour, I'm kind of like, I know Under Armour, I know Nike, I know they're going to stand behind their goods and their quality, and I'm willing to pay up for it. And that's worth something. So again, in this online world, I see a lot of the entrepreneurs starting up, and they forget about, like customer acquisition costs, just building a brand and showing, their differentiators and value beyond just a low price. Because if your stuff's manufactured in China and you're pretty much a middleman as is, somebody's going to be able to undercut your price. If they haven't now, they will eventually. So, certainly work on your sourcing and your supply, chain and network to make sure you can get those as low as possible, because margins matter a lot in this competitive world. But value can be more than price. And that's important.
And it's really interesting. I have a book back here, Jeff, called Zeconomy. And it's, I can't find it. Anyways, Gen Z, when you talked about how they're going to double from 15% to 30% of the workforce, what did you say, from 40 million some to 60 million some people?
46 million consumers to 61.
Yeah, they care more about sustainability, and also they care more about quality actually than anything else. And it goes back to demonstrating the brand and building that trust with the brand. And then it's be interesting as we watch the retail sales, or the online versus in stores, whether people they make their decision, then they just go find the cheapest price for that product, wherever it might be. Because that's how I do it.
Yeah, a lot of people do, and some things are commoditized where it is just lowest price. But you look at these earphones that are in both of our ears that are the same brand. We know there's quality. There might even be a little status symbols in that, but you can certainly find cheaper earphones. So again,
Hmm.
they've built a
Hmm.
brand. I was lucky enough to work with Apple for many, many years, helping launch iPhones and more. And they certainly had a very unique approach to building a brand. And at times they were even like, we don't really care about the ROI. We just want to be first in the search results, right? We just want
Hmm.
to have either the first opening ad in a magazine or the back page or none at all. In a commercial segment, first pod, first commercial. That's where we want to be because that's about branding. So
Hmm.
interesting approach.
It's it is, and as branding and trust and being on the different marketplaces and channels matters, then take it a layer deeper on like the categories. I thought it was fascinating, the categories that had kind of like the whipsaw over the last few years and what you see coming up into the future.
Yeah. So it's interesting. I think we saw really sporting goods with the pandemic go berserker, and that's one of the lowest now, right? One of the highest now is actually food and beverage. So more and more folks, and I mean, I was reminded of going to a big box grocery store, just this weekend, and I'm like, oh my God, normally I, go on the app and I get it all set and I just go pick it up and they put it in my trunk. I was actually walking the aisles and I'm like, this is like that's my hell. Like it
Horrible.
was crowded and
Yeah,
it was the day
totally.
before back to school, and I'm like, I never want to do this again. So food and beverage is really one of the big ones. I think health, personal care is another high growth area. So I think we'll see a few more. Another one is also, we talked a lot about Amazon, but the growth that's beyond Amazon. And I think last time I was on your podcast and I shared, Amazon was number one in terms of where consumers go for product searches. It is top of the
Hmm.
list, and that used to be Google, and so that was really surprising for a lot of people. It's still number one, but looking at like Q1 data year over year, Amazon's actually dropped in percentage. So it still is number one. Engines are number two, but where there was growth is Walmart, YouTube, Instagram, and TikTok. So people are
Hmm.
starting product searches on TikTok, right?
Oh, this
Not as
is
many, but certainly more than
just
they ever have.
crazy.
And
Yeah.
Walmart as well. And Walmart's number two. And it was kind of like in the world of search, like you had Google and Microsoft, and we're all cheering for Microsoft because we love competition and we want to even out the market. And so we're all cheering for Walmart as well, and even Target. So we'll see what they do. But yeah,
It's so
there's a lot of
fascinating to
growth.
me, Jeff. It's so
Yeah.
fascinating to me because my partners came from the world of food where they were getting manufacturers into Kroger and a bunch of other big retailers. And so, like, the amount of time spent on product placement and the shelf space and the end aisles, and like, it's insane. And what I think people like, for the listeners, it's as big of a deal. We're talking about the eyeballs on your phone, right? So like, it's a big deal that if people are going to search on TikTok, YouTube, and by the way, me on YouTube, I'm trying to find good information first before I go. Honestly, Jeff, and I'm curious if this has to do with it. Well, I'll finish my thought first. Is that like all of the things that you said is equivalent to the end aisle caps of a retail store that everybody coveted, and how fast it's moving for
Yeah.
these business owners is like, you have to be paying attention to this stuff in order to find their product growth, because you have it broken down by products, but in the old retail like store way, it would be aisle spaces and shelf
Yeah.
space and all that stuff. And so it's just that important still to be thinking about the stuff you're talking about.
Well, and it's moved online, right, with the physical retailers. So almost every physical retailer, from Walgreens and CVS to really just anything, grocery stores and more, they're allowing third-party advertisers to advertise on their site, or on the back end, if they're carrying your products, they're allowing you to promote them in different ways. And search is number one. But they're category pages. So let's use the Walmart example. And if you've got ankle braces and you're looking for some sort of wrap or whatever, different companies are able to take, and I'm just making up this example. I don't know if Walgreens or CVS does this, but, big hero image or certain placements, and they're able to pay for that stuff. And then if I wholesale my ankle braces to, those types of companies, I'm going to get more POs. I'm going to get more sales through my wholesale and B2B channel because I'm able to advertise, get more eyeballs, get more conversion rates through it. And then I have to measure it. But I have to manage this whole portfolio now, not just of like D2C consumer, but also now I've got this B2B play, right? Target, Wayfair,
Yeah.
those are all B2B plays where you have to sell at a kind of a bulk volume for a wholesale model. And then kick in advertising to help spur those sales, reviews, ratings, and more.
The game has completely changed for these manufacturers because like before you'd talk to a CPG rep who would be helping talk and build the relationships, and your goal was to build the best product and then let everybody else do their stuff. But now you have to be like an online ad specialist, like you just said, all the online stuff plus the manufacturing. There's a lot of implications. That kind of like one of my last questions about started to go down a rabbit hole is, when I think about what's happening, Jeff, like it's this crisis of like confidence and trust in these brands. I think about how horrible my experience is going and trying to find a show to watch on TV, where it was like you used to be able to flip channels, and now I have thousands of subscriptions, but then every subscription has their own channels. And I find it weird that like, not weird, but like you have every channel that now has their own app. And now look what's happening with the shift from stores to online is you have all these brands that went from, I could go to Target and just pick the brand off the shelf, for now I have to sift through 1,000 types of granola bars, 1,000 types of, you know what I mean? Like it's paralyzing for the consumers. So you have almost go back to the crisis of confidence, and like building those brands is, my guess, has got to be hugely important going forward because of how horrible the experience is on the consumer side.
I couldn't agree more. I just went pickleball paddle shopping, and there's not really, there's maybe 2 brands, but it's just a long list, and everything's the same price. And I'm reading reviews, and
did you want to be a pickleball paddle specialist before buying one?
Right. So it's just tell me, and I know, being a media person, the ones at the top are usually kind of the ones that are paying for that space. It doesn't mean they're the best, but most consumers, when you talk to them, they're like, yeah, whatever's at the top of Google or Amazon, those are the best. And I'm like, those are just the people with the biggest budgets or know how to measure ROI and target properly. But doesn't make them the best. But they're doing something right, I guess, to get eyeballs and sales.
Going back to the influencer, and the people are looking for people to tell them what they believe. Is there, as we're wrapping up here, is there anything that I haven't asked that we should cover?
No, I think that's, I think diversification is probably something I'll leave you with. And we talked a lot about that. So many e-commerce folks, and it is the bulk of sales, just go to Amazon, but Amazon is extremely competitive. CPCs have gone up. Look at alternatives. One last stat from the Association of National Advertisers earlier this year showed, they did a survey, 56% of US brands use more than 5 retail media networks. 16% use more than 10. Right. So it is about diversification. That's really where to be. And it also helps build your brand, right? You're kind of everywhere the consumer is. They see you, they recognize you, and that helps. So keep growing. It's not, the strategy isn't getting easier. It's not just, I can just give all my money to one place and cross my fingers. You really have to be where the consumer is, and the consumer is getting younger, more savvy, more digital. And I think we're all in the right place talking about those themes.
Yeah, I would say diversification of customer base, diversification of marketplace and where you're actually putting the eyeballs, and probably diversification of products and services. Because I look at the charts that you sent in the eMarketer, and if people were focused on any one of those things, the whiplash that they've probably experienced over the last 3 years is not what any investor wants. So more sustainable future cash flows is the name of the game. Jeff, this has been a lot of fun, man. Where can people find you, AiCommerce, and get in touch?
Yeah, Jeff at AiCommerce.com.
Thank you so much for coming on the show, man.
Yeah, thanks for having me again, Ryan. Good to be back.